Okay, so part two, we got the rest of the story. As Paul Harvey used to always say, here is the rest of the story. Poor guy. He ended up having throat cancer and he couldn't talk anymore. Alright. So the next thing we're going to look at is profit margin ratio. Profit margin ratio takes net income divided by sales, so everything is divided by sales. Net income was right over here. Where'd it go? Net income. Okay, there it is right there. 162,200 is in the numerator, and then the denominator is sales. And when you get into accounting 212, I'm going to talk about this on CVP analysis, that everything's divided by sales, everything's divided by sales, everything's divided by sales. And same thing here. Everything, net income is divided by sales. Well, their profit margin ratio is 21.1%. Is that good? I don't know. Compare it to some other company, and that's when you wind up doing that and looking to see how the other company's doing. The other company, company, is doing better than Barco because of that. Total asset turnover takes net sales divided by average assets, and so I'm going to take 770 sales. I'm going to divide by my total assets. I'm going to take total assets here, 445, 440, and I'm going to add last year's total assets. So let's look over here. Where did it go? Total assets, 398,000, and I'm going to add them together, divide by 2 to get the average. And that means that I am generating enough sales, 1.8 times, to handle my total assets. It just basically says how efficiently am I generating sales, and I'm doing it 1.8 times. Okay, return on total assets, here's a very similar situation. In the numerator, you have net income of 162,200, and here's net income 162,200, and I'm going to do the same thing. I got total average assets, so exactly what I did here, I calculated here. I'll do the same down here to get total average assets, and this time this is looking how net income operates, or how well we do with net income with our total assets, and it comes out to be 38.5%. That is the return of net income compared to total assets. How is that a good number? Don't know. That's why you compare it to another company. Okay, it looks like Cayenne's doing it better than Barco company. Then we have return on common stockholders' equity, and this is again very similar. You have net income in the numerator, numerator. And then in the denominator is going to be total common stockholders' equity. How do you find that? It's right here. You have common stock and retained earnings. These are the two things that show up in equity, right? So 180 plus 123,300, that should be the 303,300. And then let's look over here at this part. We have common stock and retained earnings from last year's, because this is an average, 180 and 98.3. Okay, there it is, 278.3, the two added. So add this year's and last year's, divide by 2, and we're at 55.8%. That says how efficiently are we generating net income to use other people's money, because that's what equity is. It's other people's money. It's the owners of the company. It's their money. Okay, so how efficiently are we doing that, and how efficiently are we using net income for the assets that we have at our disposal? Okay, next one, price earnings ratio. Okay, so price earnings ratio, you have to do a little bit of digging to find this one, but in the paragraph here they give you the purchase price of a share of stock. That's what the $75 is in the numerator. The numerator is the purchase price per one share of stock. Okay, so company stock can be purchased at $75 per share, and that is for Barco Company. And it says here, assuming that each company stock can be purchased. So, okay, so $75 is going to be the same for both of them. Phew, boy, that's a little less digging. Down here at the bottom, they're talking about price earnings. So price, that's market price, is $75, and earnings is going to be the earnings per share, which usually shows up at the bottom of your income statement. They show basic earnings per share, 4.51, and that's what's in the denominator. So it's price to earnings per share, market price to earnings per share, and then we come up with 16.6. In other words, what they're saying is, how good is the market price for a share of stock compared to the earnings per share? And this is calculated by taking net income divided by total shares outstanding. So this is how efficiently we are using net income for the outstanding shares of our company. That's what the earnings per share is, and then we're comparing that to the market price. And right now it looks like the return is 16.6. Okay, market price to earnings per share. And then of course you also compare it to the other company. Dividend yield. This is a very common one, actually. A lot of people use this. They want to see what the return is on their dividend payment. So you take 3.81, and that is the cash dividend per share. Okay, $3.81. So each share that you have, you receive that much dividend. Okay, and you divide that by the market price. Okay, what's it selling for out there on the market? So the dividend to the market price says that I have a return of 5.1% on my dividend. Okay, this is kind of like interest. Interest is calculated by taking the interest amount divided by the total investment. Okay, and so this is basically taking the same thing, the dividend divided by the investment. Okay, $75 per share, and this is per share. So you're comparing apples to apples, and that's telling us that the return on dividends is 5.1%. The other company, Cayenne Company, is doing 5.2%. A little bit better, just a little bit better. Okay. When we get to the very end of all of this, we take a look and see what's going on here. And we're going to start by comparing company side by side, starting with current ratio. Okay, so the current ratio was 2.5 and 2.6. Looks like Cayenne's doing better because they have a better current ratio. Acid test, 1.1, 1.1, they're neck and neck, okay? So they're pretty straightforward, the same. Accounts receivable turnover, looks like Barco turns over more times than Cayenne does, okay? So they're more efficient with their accounts receivable than Cayenne over here on the right. Inventory turnover, they do it 8.4 times, Cayenne does it 5.3 times. So again, Barco does it more efficiently than Cayenne does. Alrighty, they turn over both their accounts receivable and their inventory more efficiently. If you really want to know how many days, here it is down here. Barco's days sales and inventory, 52.7 days versus 76 days. So stuff stays in inventory longer for Cayenne than they do for Barco, so they sell it off the shelf more quickly over here than over here. And accounts receivable, days sales uncollected, 22 days versus 26 days. That means that company on the left collects more quickly than company on the right. So who do you think is more efficient on the short-term basis? I'd say here, Barco both turns its merchandise and collects its accounts receivable more rapidly than does Cayenne. On this basis, Barco is probably the better short-term credit risk. So if you're doing day-to-day buying and selling stock on a regular basis, you know, buy stock low, hold it for a few days, sell it when the price goes up, looks like Barco would be the better deal because they turn over everything more quickly. Let's take a look at the next part. Profit margin was better for Cayenne than it was for Barco. 24 versus 21%. Their asset turnover a little bit better over here on the right side. Okay. Return on assets a little bit better for Cayenne. They do 45% versus 38%. Okay, so that's looking more impressive. Over here, Cayenne's doing 65% on their common stock, return on common stock holders' equity, 65 versus 55. Still, they're whooping up on Barco Company. Price earnings ratio. Looks like Barco's just a tad better than Cayenne Company. Okay. That's probably because they have a bigger earnings per share. Okay. So that means on the earnings compared to earnings per share, Cayenne's a little more affordable than Barco is. And then on dividend yield, 5.2 versus 5.1. This is a better interest rate right here, better return on dividends than over here. And so when we are looking at this, profit margin, total asset turnover, return on assets, return on stockholders' equity are all higher for Barco. That's the company on the right. I'm sorry, Barco's on the left. Okay, let me go back and look at that again. Yeah, it's higher than Barco's, yes. So Cayenne was actually the better company on profit margin and all that. All the companies pay roughly the same dividend. Cayenne's price earnings ratio is lower, so Barco did beat them out on that one by a smidgen. All these factors suggest that Cayenne stock is likely the better investment. So we're talking about the company on the right. Even though on price earnings, company on the left did better in the price earnings than the company on the right. All these numbers were higher than over here, including the profit margin was higher than over here for Barco. And their return on dividends was higher than for Barco. So we would probably go with Cayenne. Okay. That's the analysis part. That's the fun part. The other stuff, the calculating, you know, that's just number crunching. Okay. If you can handle this, you got the final exam in your back pocket. Everything's going to be great. You guys have a good one. Take care. We'll see you later.